You only get approximately 50% of your paycheck when you retire from the military. Do you think that you can survive with a 50 to 60% pay cut? This is Josh from the O-Call, and today I'm going to show you why you should be investing in your TSP. If I started investing in my 20s instead of my 30s, I'd have approximately $825,000 more than I would have now because of when I started. Don't let this be you. Before I get into the TSP specifics, look at this. Let's pretend that Alex started investing $1,000 every month, starting at age 20. If we come over to this dividend calculator, we start with $0. Annual contribution would be $12,000 every month. Dividend rate down for 20 years because that's how long he'll be in the military. So he would then have $488,000. So if we take that number then and turn it into the principal, and then he doesn't contribute another dime for the next 20 years until he turns 16, he's able to retire and draw that pension. He'd have $1.75 million. Now let's contrast that with me, because I started at 30 years old instead of 20, so I'd have 10 less years until I could retire. So then if we go down to 20 years on this calculation, down to 10, that's what I would have. I'd have just under $1 million. However, this is still an $825,000 difference, or a 47% difference. Following is not financial advice, and I'm not a financial advisor, but with that disclaimer out the way, let's get into the TSP. Let's talk about contribution matching in the blended system. You can see here that you have an automatic contribution of 1%, regardless of what you put in, and you get up to a 4% match. So basically this means that if you were to put 7% in, you would get your 7% plus the automatic 1% plus the 4% for a total of 12%. Also, if you're going to change your percentages, you're going to do it in MyPay. You're going to come down here and click this little yellow button, and it's going to take you to this screen right here. If you don't invest in the TSP, you could be turning down a 5% raise and extra retirement money. Unless you've been in the Army since 2018 and you stuck with the old plan, you're going to be enrolled in the blended retirement system. Real quick, here's some differences between the legacy and blended systems. So under the legacy retirement system, you're going to get 2.5% times the number of years served times your highest 36 months of base pay. And then you can contrast that with the blended system. You're only going to get the same equation, but 2% instead of 2.5. So the big difference is 50% of your paycheck or 40% of your paycheck. This means that a lieutenant colonel with the legacy program with 20 years in service, making $10,544 a month of base pay, is going to get $5,272 in retirement. Under the blended system, that same lieutenant colonel would get 40% of their base pay, which then turns into $4,217. But even though that lieutenant colonel under the blended system is going to make less than the legacy, they have some other perks, like that 5% TSP match. They're going to get a continuation bonus, and they're going to be able to take that retirement with them if they get out before 20 years. I mentioned the continuation pay, and that's basically when they reach 8 to 12 years in service. Active duty members will be eligible for a cash incentive for 2.5 to 13 times their regular base pay. And then Guard and Reserves will be eligible for a different lower number. That same lieutenant colonel, if they were under the legacy program, they would not get their retirement if they got out before 20 years. Now that we talked about retirement plans, what are you actually investing in with TSP? Oh, and also, all of the links to the websites I use to get this information can be found in the description below. To see what kind of funds we're going to invest in, you go to the Thrift Savings Plan website, go to Investments, and then down to Fund Performance. And down here, you're going to see all the different kind of funds that you can invest in. There's a bunch of L funds, S funds, C funds, I fund, F fund, and G fund. If you want to change what fund that you're investing in, you have to do it here on the TSP website. You can't do that on MyPay. I'll explain what the different funds mean in a minute, but check this out first. If you come over here to the C fund, you look at the 5-year, 12.5-ish%, and then we come over to the dividend calculator again. Let's just say that we start with 0, annual contribution at $1,000 a month. We come down to stock appreciation at 12.5%, and then 20 years in the military. You can see if you just did that $1,000 a month at that percent that the C fund had, you come out with $1.7 million at retirement. Now, you're still probably wondering what the different funds mean, right? So we'll start with the L funds, which are Lifecycle Funds. And each of the 10 L funds, they have a diversified mix of the 5 individual funds. So you got the G, F, C, S, and I. And then the fund dates are basically the target dates that you're going to retire at. So for example, the L2065 is designed for people who plan on retiring and beginning withdrawing their money within a few years of 2065. And then if you look here, every quarter, the L funds are going to be rebalanced to have lower risk as they get closer to their target date. And if you're interested in L funds, but you don't know when you're going to retire, you can come down to this other page and then look for your birthday. And that's probably going to be a good indicator of what fund you might want to be invested in. And then up next is the G fund. So this one is the safest, but it also has the lowest return rate. This is typically the one you would choose in retirement, or as you get closer to retirement and you want a little bit more security. The G fund is invested into U.S. short-term treasuries, and payments of the principal is guaranteed by the U.S. government. Now, this fund is also designed to outpace inflation. However, the last year or two, that hasn't been the case because inflation has been pretty high. Now up next is the F fund, which are bonds. And the topic of bonds could be its own video, but I'll try and summarize this as best as possible. So if you look here, the risk of non-payment for these bonds is pretty low because the F fund only includes investment-grade securities, and it claims to be broadly diversified. And then you can see here all the different types of bonds. Of the investment-grade bonds that the F fund is in, they range from BBB all the way up to AAA. This is normally a good hedge against the stock market corrections and dips. However, at the moment, bonds are upside down and are not as safe as they normally are. I say this because when markets dip, investors and hedge funds move their money from stocks to bonds. However, at the moment, bonds are upside down in value and aren't very attractive. The C fund indexes itself to the S&P 500, which is one of the biggest markets. The S&P 500, for those of you that don't know, is an exchange-traded fund that holds the top 500 best-performing stocks in the U.S. stock market. And the famous investor Warren Buffett was once quoted as saying that if he had to pick one stock to invest in, it would be the S&P 500. When you hear people refer to the market, most of the time they're referring to the S&P 500. The S&P 500 typically provides a return of 10% on average. And those of you who have sat through the mandatory TSP briefs in the past, and they wonder where they get the savings rate of 10%, well, this is it. And up next is the S fund. This one closely matches the Dow Jones Industrial Average. Its publicly traded ticker symbol is DIA. However, with the S fund, it's not going to have any of the companies that are included in the S&P 500. I forgot to mention that the S&P 500 publicly traded ticker symbol is SPY, or SPY. And if we scroll down to this other page, if you were to combine the S and the C funds, it would basically cover virtually all of the US stocks in the market. Now, personally, I'm a big fan of the S and C funds overall because those are some indices that I already invest in with my main taxable and non-taxable accounts. I will say, though, that you're going to need to learn for yourself why these funds are good because that'll tell you when to be in or out of them. A good comparison for the C and S fund combination is the publicly traded ticker symbol VTI, and that's the total stock market index. And if you're investing in that, then you're basically betting on the entire U.S. economy. And then lastly is the I fund, which is international stocks. It says here that the I fund offers the opportunity to earn a potentially high investment return over the long term by investing in the stocks of companies in most developed countries outside of the United States. Now it says international, but I think it's important to note that there are currently no holdings in Russia and minimal holdings in China. I will say, though, that international stocks are impacted by global conflicts and crises. And if you look here, these are all the different countries and percentages that are in this I fund. Now, international stocks can normally be used as a hedge against U.S. stock market turmoil, but that doesn't work when the rest of the world is experiencing turmoil as well. So you just got this fire hose of information, right? But wait, there's more. Do you set up your TSP as a traditional or a Roth IRA? So here's some information on traditional IRAs. So they're not taxed until you withdraw them in retirement. The contributions are tax deductible, so you can claim them on your taxes, which can lower your taxable income / tax bracket. The limit is $6,500 per year combined unless you're participating in an employment retirement program like the TSP. And then if we look at the Roth IRA, which is my personal favorite, contributions are made from already taxed income out of your paycheck, and they're not taxed again in retirement. However, the contributions in a Roth IRA are not tax deductible, and the limit is still $6,500 as of 2023. I just mentioned that the traditional IRA is taxed and the Roth is not. So here's an example of the differences between how much money you can get on a taxable versus a non-taxable account. So at the end of the 30 years, the taxable account would have $614,000 and the Roth would have $696,000. And if you read through the example, at the end of the day, the taxable versus the non-taxable, it's a $764 a month difference. You can find this example and more in the book that I wrote about investing in the stock market. On another note, let's say that you graduate college at 22 years old, and then you do 20 years in the Army, so you retire at 42 years old. You could either A, in theory, You can live off of your pension, any disability that you have, and then you can live off of your taxable account dividends until you turn 59 and a half, and then be able to withdraw from your IRAs or your TSP. Or you can get a second career and fully retire at 62 years old and then have double the retirement funds. The choice is yours, but whatever you do, don't sacrifice your future for immediate gratification in your 20s or 30s. If you found this info helpful, then consider subscribing to the O-Call podcast, because we got a lot more content coming your way. Oh, and if you're an Army officer, then watch this video next to learn about 7 helpful websites that you need to know about right now.
I got dreams, got things that I want to do. I got plans, got schemes.